Welcome to Module 3 of our Consumer Goods Suite. In this module, we will look at financials and key performance indicators. A balance sheet is a snapshot of financial data for a specific moment in time, normally the end of a company's financial year. The balance sheet gets its name from the fact that it has two sides or halves and they must balance. One side shows the money invested in the business and the other shows how it has been spent. Mathematically, it is expressed as assets minus liabilities equals equity plus retained profits. Equity and retained profits is the money invested in the business. Most people studying this programme will not be able to address this. For our purposes, we are concerned only with how the money invested in the company is spent. Assets can be subdivided into fixed and current. Current assets is defined as cash or assets which can be turned into cash in 12 months or less. Fixed assets are assets that are purchased for long-term use and are not likely to be converted quickly into cash, such as land, buildings, trucks and equipment. Accounts receivable, AR, is what wholesalers and retailers owe the company for products that have already been supplied. This is typically purchase orders the company has received, for which it has shipped the goods and is now awaiting payment. Ideally, payments will be made within agreed terms, for example 60 days. Days Sales Outstanding, DSO, is an important KPI to consider when evaluating current assets. DSO is a measure of the average number of days that a company takes to collect revenue after a sale has been made. Look for signs that the number of days is extending, as it indicates inefficiencies creeping in which you might be able to help them improve, depending on what you sell. Also keep in mind that 10 years ago manufacturers only sold to businesses. Today some of them sell direct to consumers, DTC, and consumers pay faster than businesses, so as DTC revenue share grows, DSO should reduce and cash flow should improve. Retailers' continuing efforts to expand their private label sales is encouraging more manufacturers to develop a DTC operation. Inventory is categorised into three components based on the various stages of product completion: raw materials and supplies, work in progress, finished goods. Another key metric is inventory turn. Inventory turn is defined as the cost of goods sold divided by average inventory at cost. Technically, this should be average inventory throughout the year. When you're examining a company's accounts though, you can mostly only see the end-of-year inventory figure. You can calculate the inventory turn using the end-of-year number, and as long as you compare it with figures from other years produced on the same basis, the comparison will be valid. Look for inventory turn getting slower compared to previous years. This is another indication of possible sales opportunities.